Well, hello everyone. Today is April 20th. It's a Monday. April is 2/3 behind us. Coronavirus is still here. Beaches are now open. And what do I always say every day? Let's get into it right now. So let's talk about the big reports for the week. Let's talk about what we can expect from the market this week. We've got existing home sales. That's going to be pretty big. We got the petroleum status report. That's not going to be really big. Crude oil just opened down substantially. I mean, we're talking down. Let me show you what we're talking about here. Down 36% on the May contract. Can you imagine that? 36% down. So we already know what crude oil is going to be saying. But all jokes aside, jobless claims, new home sales, existing home sales, and durable goods. These are going to be the big reports. Also, typically, consumer sentiment is not a huge report, but with everything we've got going on right now, and the fact that this consumer sentiment takes into account the entire window that we've seen coronavirus, that's going to be a really, really important report. Because remember something, consumers account for 75% of the GDP, of the gross domestic product. So it's really important to see what consumers are thinking just about right now. Today, we're going to see a lot of activity because of crude oil, but as we get into the week, we're going to be focused on the jobless claims, new home sales, durable goods, and consumer sentiment. But overall, the market is still being driven by fear from coronavirus. Let's talk about global economy really quick. I've highlighted the really important parts to give you guys a really broad picture. World shares turned lower on Monday as momentum from last week's rally faded and oil prices retreated, with U.S. crude contract plummeting to a two-decade low under $12 a barrel. I know it sounds hard to believe. I'm going to show you what I'm talking about. This is the May futures contract. It's at $11.54. Look at this thing. I mean, this thing has just plummeted. So let's continue here. Japan reported Monday its exports fell nearly 12% in March from a year earlier as the pandemic hammered demand. Quite honestly, 12% based on everything we've seen, it's not as bad. I mean, honestly, I was expecting 20% plus. Benchmark U.S. crude oil for May delivery lost $6.58 and is now trading in the mid-11s, its lowest level in 21 years. Concerns about storage facilities being near capacity pushed down the price, as the technical factors with futures contract due to expire this week. The next contract for June was trading substantially higher at $22.23. So this huge selling pressure, that's only in the near-term contract. If you were to look at the ETF that trades oil, it's only down about 11%. 11% is quite a bit, but it's not 36%. But in all honesty, it's quite a lot. I mean, this is quite a lot. Decline in China's benchmark lending rate, which mostly affects big state-owned companies, helped support the Shanghai Composite. People's Bank of China paved the way for a monetary easing last week by reducing 0.2% rate called the medium-term lending facility, which forms the basis for the loan prime rate. U.S. Treasury yields remain extremely low. Bond prices have been going up. The yield on the 10-year Treasury slipped to 0.63 from 0.64. And the S&P 500 is still down roughly 16%. So don't get your bull market hat on just yet. From its record high in February, some 22 million U.S. workers have lost their jobs. 22 million people. That's amazing. And lots of businesses have shut down. Now, looking at the S&P 500, this is going to be a very big week because we've been going higher ever since March 23rd. So we've been going higher now. We've bottomed out. We've been going higher. We've recaptured about 50% of this trend. And we're now sitting at the 50-day moving average, which has crossed down. This is a death cross. It's crossed down below the 200-day moving average. So we were above the 50-day line for a minute, but we were still below the 200-day line. And if you look on a weekly basis, is this the weekly? Yeah, this is the weekly basis. You will see here that we're still below the 50-day moving average, although on a weekly basis, we are above the 200-day line, which is positive. All in all, my prognosis is that we're going to back down. We're going to come back down, probably eat about half of this, and then start coming back up. I don't think the market is ready to come back up just yet. With that said, the NASDAQ 100 doesn't have a lot of the assets or a lot of the stocks that you're seeing in the S&P 500. It doesn't have the oil, doesn't have the industrial, doesn't have the production stocks. All of those stocks are keeping the market lower. If you look at the upper end of the range, you'll see consumer discretionary, technology, and healthcare, which is what's made up in the NASDAQ 100. This is by far the strongest NASDAQ, the strongest index, and it's still trading substantially above, even with the pre-open, it's still trading above the 50-day and the 200-day. And notice something important. The 50-day line never crossed below the 200-day line like it did on the S&P 500, which I'm about to show you right now. If you look at the SPY, notice we've had the crossover. We never had it on the QQQ. Either way, I'm expecting the broad market, which is the S&P 500, to push the NASDAQ lower because there is a correlation of about 95% overall. And those big stocks like Apple, Amazon, Netflix, they're all in the S&P 500 and the NASDAQ 100. As a matter of fact, if you look at the NASDAQ 100, you will see that each and every one of those stocks, or most of those stocks, are in the S&P 500. There's just 400 more, and a lot of them are oil, energy, production, material, things that are not moving right now. So that's putting a weight on the S&P 500, which we're not seeing on the NASDAQ 100. Now, I believe we're going to curl lower. I believe the S&P is going to come down, probably not all the way down because there's a lot of fear here, but probably come down to the 2430 level, which is the 243 level on the SPY. Bond market is high, and I believe the bond market will go higher. There's a good chance the bond market will take out this high as prices have been shifting away from the US dollar and back into the bond market over the past 3 weeks, because now this coronavirus, it's not just impacting Italy and Asia, it's impacting the world. So at first, investors were really keen on putting their money in the USA, betting that US would have a better chance of pushing back or fighting the coronavirus, but it didn't happen. So the money initially went into the US dollar and out of the bond market, and then since that time it went back, and it's been quietly shifting away from the US dollar into the bond market, which is now higher again, and the gold market, which is higher as well. And I'm expecting more upside in the bond market. Not sure about the gold market. I would expect out of the two, the bond market to show more strength because there is some flight to quality. And again, interest rates are still positive in America, and the bond market tends to be a better hedge than the gold market. It tends to be a slightly more natural hedge. So with the U.S. stock market expecting to see some downside, expect the bond market and the gold market to possibly cool off. But out of the two, if you're looking for more upside, I think the bond market is going to ultimately give you more upside than the gold market in the near term, because I believe the gold market tapped out right here. The RSI went higher, whereas the bond market has been fairly stagnant and looks like it's ready to go higher. And look at the volatility. It's been really, really low. Lower volatility tells us there's a good chance assets will continue trending, whereas gold has been a little more choppier and has gone through the overbought level. Volatility levels, well, they've been going higher, but I'm expecting, and it's this, we got so many indicators here, it's hard to determine what's what. But if you look at this line here is volatility. This is the S&P 500 volatility, and it's been going lower, but I'm expecting it to start going higher, probably hit the 55, 65 level, maybe 65 level. I don't think we're going to hit the 80 level. This was based on total unadulterated fear when the stock market came down here. I don't think the stock market is gauging at 100 to 250,000 deaths from the coronavirus anymore like it did a month ago. I think the numbers are now more 50, 60,000. We're closer to the cure. There's less panic. The downside is predicated on actual numbers as opposed to being just an assumption that is a moving target. We have a lot better understanding of where we stand, how long it will take us to recover, when we will have a cure for this now than we did a month ago. So I believe the level of fear that we saw in the S&P 500 will continue to cool off, but we're going to see some bumps in the road. ultimately, don't be surprised to see the S&P 500 go from the 282 level down to the 240 level over the next week or two. It's not surprising. We're not out of danger zone yet. Not even close. We're getting there slowly and surely, but it's going to take a little bit more time for us to get there, so we have to be patient. Until we do, expect a roller coaster from the stock market. The odds are the S&P will go down because of oil next few days, and because of earnings, they're a lot worse than expected. But then things should get better as we continue to see progress from the healthcare stocks. There's 6 companies working on a vaccine right now, and we should see more upside from technology because China is recovering now and looks like things are moving back to work or back towards that scenario. Now, before I let you go, I've got one question for you. Do you want to retire with a fortune? Of course you do. Who doesn't? Who wants to sit in a cubicle till they're 80 years old? Nobody wants that, right? I mean, come on. People want to spend time with their kids, with their family, with their loved ones, with their friends, traveling, going out. Nobody wants to sit in a cubicle. Of course everybody wants to retire with a fortune. Nobody wants to pack grocery bags till they're in their 90s or bring back cartons for tips from supermarkets. I know it sounds cold, but I'm being honest with you. Nobody wants to retire poor. Everyone wants to retire with a fortune. If so, I just uncover a breakthrough trend, and I expect to deliver massive market-crushing returns for 3 specific stocks for years to come. That's right, 3. Not 4, not 5, but 3 very special stocks. What these 3 companies have in common is that they're being double funded. That's right, double funded. This double funding, you're gonna love this. You see, these stocks are likely to be showered with cash from the $2+ trillion package and institutional investors who want to get into this mega trend. Folks, you do not want to miss these 3 stocks. The companies I'm looking at could easily become some of the world's most valuable. I'm not kidding. This coronavirus, it's going to change wealth. It's going to redistribute wealth. A lot of companies that we thought were vital are not going to be as vital. And a lot of companies that we didn't think were as important are going to be as important. For example, healthcare stocks, after they find vaccine, expect Apple, the value that Apple has, to move into healthcare. Things are going to be changing. This is like 9/11 all over again, but in a positive way. Now, the companies I'm looking at could easily become some of the world's most valuable. I'm serious about that. And I just published a report about this trend and my favorite way to play it. Folks, this is time for opportunity. A lot of people are thinking the world is over. No, this is opportunity. Whenever something happens as awful as this, there's always a silver lining, and this is it. Click the link below or follow the button at the end of this video to get all the details. Double funding, retire with a fortune, cash in on what the Fed is doing right now. This double funding is going to help a lot of stocks go up. When the Fed gave money in 2008, it doubled the size of the global economy between 2008 and 2014. And guess what they're doing? They're doing it again. So we're going to see a crazy bull market when all of this is over. But I've got 3 stocks for you. Folks, you don't want to miss this. Click the link below or the button at the end of this video. Don't miss out. Do it now. This is the opportunity you've been waiting for. I'll talk to you soon. You guys have a great day.